Welcome back! In this quick CPA review, we are covering adjusting journal entries. The purpose of adjusting entries is to apply accrual accounting. They ensure revenues are recognized when earned, expenses are recognized when incurred, and assets and liabilities are reported correctly at the end of the accounting period. Remember that the CPA exam follows accrual accounting, not cash accounting. Adjusting entries exist because cash and recognition often occur at different times. There are 4 types of adjusting entries you should memorize: prepaid expenses, unearned revenues, accrued expenses, and accrued revenues. Prepaid expenses and unearned revenues are known as deferrals, while accrued expenses and accrued revenues are known as accruals. An easy way to remember these entries is that deferrals involve cash first, while accruals involve earning revenue or incurring an expense before cash is received or paid. Let's begin with prepaid expenses. A prepaid expense occurs when cash is paid before the expense is incurred. The company initially records the payment as an asset because there is still future benefit remaining. Common examples include prepaid rent, prepaid insurance, prepaid maintenance, and supplies. As time passes and the benefit is used, an adjusting entry is required. The journal entry is debit expense and credit prepaid asset. Expenses increase while the asset decreases. Think of it as using up the asset and recognizing the expense. Next are unearned revenues, also called deferred revenues. Here, cash is received before revenue is earned, so the company initially records a liability because it still owes goods or services. Common examples include unearned rent, deferred subscription revenue, gift cards, season tickets, and deferred service contracts. As the company performs the service or delivers the product, it earns the revenue. The adjusting entry is debit unearned revenue and credit revenue. The liability decreases because the obligation has been satisfied, while revenue increases. Remember, revenue is recognized based on performance, not when cash is received. Now let's discuss accrued expenses. These occur when an expense has been incurred but cash has not yet been paid. Since nothing has been recorded yet, an adjusting entry is necessary. Common examples include salaries payable, wages payable, interest payable, utilities payable, taxes payable, and bonuses payable. The journal entry is debit expense and credit accrued liability or payable. Both the expense and liability increase. The exam frequently tests whether expenses belong in the current reporting period even if payment occurs next year. If the work was performed this year, the expense belongs this year. The 4th category is accrued revenues. These occur when revenue has been earned before cash has been received. Examples include interest receivable, rent receivable, and services performed but not yet billed. The adjusting entry is debit receivable and credit revenue. Both the asset and revenue increase. Think, we've earned it, now let's recognize it. Another important category involves estimates. Some adjusting entries rely on estimates rather than exact amounts. Common examples include depreciation expense, amortization expense, bad debt expense under the allowance method, warranty expense, and other estimated liabilities. The general adjusting entry is debit expense and credit a contra asset or liability. For example, depreciation credits, accumulated depreciation, bad debts credit, allowance for doubtful accounts, and warranties credit warranty liability. Remember, estimates are normal adjusting entries, not accounting errors. The exam likes questions where an expense account already contains an incorrect balance before year-end adjustments. Don't simply accept the existing balance. Ask yourself whether any prepaid amounts should be removed because they relate to next year, and whether any accrued expenses should be added because they belong in the current year but haven't been recorded yet. The same idea applies to revenues. Remove amounts that haven't been earned yet and add revenues that have already been earned but haven't been recorded. Adjusting entries simply update existing account balances at period end to reflect the proper amount of revenue, expense, asset, or liability. Let's finish with a quick summary of the adjusting journal entries for each account. Prepaid expenses will debit expense and credit prepaid asset. Unearned revenues will debit unearned revenue and credit revenue. Accrued expenses will debit expense and credit payable or accrued liability. Accrued revenues will debit receivable and credit revenue. If you understand whether cash happened first or whether earning happened first, you'll almost always identify the correct adjusting entry on the CPA exam.